Welcome to the deep dive. Today we're diving into really a major global shockwave. It's dominating the headlines. We're talking about a new broad-based U.S. tariff regime. And this powerful headwind, it's currently overshadowing what's actually been a pretty decent Q2 earnings season. So our mission today is to try and cut through some of that noise, help you understand the complex forces at play and, what it really means for the global economy and maybe your own financial landscape. Let's unpack this.
Yeah, and a crucial element here is just the sheer scope. We're talking about the new U.S. tariff regime formally announced by President Trump. These tariffs, they range from 10% to over 40% on dozens of countries, and they're set to kick in August 7th. Analysts, they're not seeing this as just some temporary tactic. They're really calling it a structural rewrite of global trade.
A structural rewrite. That sounds significant.
It is. The implications are profound. You're forcing corporations into really costly decisions about reconfiguring their entire global supply chains. Plus, it introduces persistent inflationary pressures, and, well, it chills corporate capital spending decisions. It's not just uncertainty anymore.
Right.
It's companies having to rethink fundamental business models, investment plans. That kind of thing really grinds long-term growth to a halt.
And you mentioned the range. Can you give us a couple of examples of those numbers?
Sure. Canada is looking at 35%. Switzerland, a pretty steep 39%. India is at 25%, and that comes with an unspecified penalty for trade with Russia. The EU is at 15%, which, interestingly, was actually seen by some as relatively favorable in this context.
15% seen as favorable. Wow. Okay, so with these big structural changes on the horizon, how are the global markets reacting? What are you seeing?
Well, it's pretty much what you'd expect, a literal sea of red across global equity markets. Asian markets, for example, they're now in their sixth straight session of losses. South Korea's main index, the Kospi, it tumbled 3.9%.
Oh.
And European markets, like Germany's DAX, down around 1.7%. And that European sell-off is interesting, like I said, about the 15%. It shows that even countries getting maybe better deals are still feeling this broad fear about a global slowdown.
Are we seeing impacts on specific sectors or companies already? You mentioned India at 25%, for instance.
Oh, absolutely. You can draw direct lines. Think about Apple. Their whole strategy of using India as a major export hub for iPhones, that's directly threatened by this 25% tariff.
Makes sense.
And then you've got luxury retailers. Shares in, say, Watches of Switzerland fell over 5%. That's that steep 39% tariff hitting Swiss goods directly. It's very real, very immediate. Companies are having to rethink their entire operational footprint, like right now.
Okay, so that's the tariff gloom. But you mentioned earlier there's this counter-narrative playing out with the Q2 earnings season. How does that fit in?
Yeah, it's fascinating, actually. What's insightful is how these company-specific reports are still causing huge price swings. It's creating a really bifurcated market. On one side, you have what some are calling this AI-driven divergence. Big winners like Meta Platforms, Microsoft. They're delivering blowout results.
Mostly driven by AI.
Mostly driven by AI monetization, yeah. In advertising for Meta, cloud services for Microsoft. They're the ones using AI effectively.
So they're like the users of the AI infrastructure capitalizing on it. But I think you mentioned earlier there were some surprising laggards in the chip space.
Exactly. That's the other side of the coin.
Yeah.
You connect those winners to the, well, surprising laggards. Key semiconductor players, think Qualcomm, ARM Holdings, Lam Research, they fell sharply, mostly on cautious forward guidance.
What does that signal, do you think?
Well, it could signal a potential market shift, maybe away from the build-out phase of AI, where everyone was piling into the shovel makers, the chip companies, towards the monetization phase. The focus might be shifting now to the actual users of AI.
Interesting. Like the builders had their run, and now it's about who can actually use the tools effectively.
Precisely. It's a really fascinating potential shift to watch.
Okay, so looking ahead just a bit. Today, we've got critical domestic data coming out. The U.S. July non-farm payrolls report. That's due 8:30 a.m. Eastern. And this feels like a classic good news is bad news situation for investors, doesn't it?
It really does. If the report comes in significantly weaker than expected, points to a slowdown in job creation, that could actually boost calls for a Fed rate cut. Expectations for September are already up near 69%. So maybe get a relief rally.
That's the flip side.
The flip side is a weak report could just confirm that the economy is weakening right when we're getting hit with this tariff shock. That would amplify recession fears. And, it's complicated because yesterday we got that stronger than expected core PCE inflation number.
Right, the Fed's preferred gauge.
Exactly. And that stronger number gives the Fed less flexibility, less room to cut rates, even if payrolls are weak. It's a tight spot.
So putting it all together, what does this complex picture mean for you, the listener?
Well, I think today's market is really defined by this powerful clash, right? You've got this fundamental structural shift in global trade policy banging up against surprisingly resilient corporate earnings, at least in some pockets. The bottom line is volatility is likely to stay extremely high. You should probably expect more sharp moves in individual stocks, even as the broader market tries to digest this new trade reality.
Yeah, our sources for this deep dive really offer so much food for thought. And maybe for you listening today, the thing to mull over is this. How will this structural rewrite of global trade, as our expert put it, impact the companies that make the products you use every single day? And what does that signal about where global supply chains might be headed next?